Good morning, everybody, and welcome to this morning's post-budget webinar. Just to say thank you for attending in such large numbers. We actually have 90 people registered to attend. So such a large number means we run this as a webinar and not as a meeting. So that will mean that you will notice your microphone is muted, but you can still send us questions via the functionality within Zoom, or you can email questions into info@abm.ie. So there will be a Q&A for both speakers, which we will do at the very end of the webinar. This event does count for CPD, and CPD certs, if required, you can email myself or Sean. So I was with a smile late last night when I got a couple of emails from people asking me, does the event count for CPD? And when I confirmed it did, they registered right now. For the rest of ye are here purely for the joy of learning. So with that in mind, I want to introduce our first speaker, Seán Pierse. So Seán and I have worked together at ABM for 21 years. So for some of you, you will be working with Seán directly as his financial advisor, and for others, I'm sure you'll have met him along the way. So Seán, over to you. The floor is yours.
Thanks, Owen. So we're going to put up our slides here now, and hopefully you'll see them soon. So generally, what I'm going to cover in my 20-odd minutes today is auto-enrollment, the change in the pension fund thresholds, how it may be higher than we originally thought, action items to sign, what you need to be aware of when you're signing your retirement claim forms, how this has been a really interesting year in financial markets. And one of the main stories of the year, obviously, is the tariffs and the Euro-US volatility. So auto-enrollment, really good website there listed is the government website. If you just read it, get the information that as required. Also, the life companies provide very good employer and employee webinars. If you just listen through it, you become quite informed. So with the with auto enrollment, it's if you do nothing and your employees are not in a pension scheme, then through NERSA, they will take money. The government's going to take money out of your bank account in order for you to actually fund this auto enrollment. And what we're saying is that auto enrollment is very good, and it's particularly good for 20% taxpayers. However, if some of your staff are 40% taxpayers, then they will get more tax relief. They get at the higher rate of 40% if they actually are in either a master trust or in a group PRSA. And if you want to do this, what we're saying is that there's a date of 13th of December where NERSA with Department of Social Protection are going to look back, and if you haven't posted any PRSA or Master Trust when you upload your monthly wages, that actually your employees will go down the auto enrollment route. So my bottom slide says here that if let's say it's a PRSA or Master Trust, they don't necessarily need to be set up, but to avoid the auto enrollment in your organization, you need to report the PRSA or Master Trust in November. So that's very soon. So means you need to be, as most people are, just on the ball on that. So moving on to the pension fund threshold. As most people are aware, the expectation. So we have an actual threshold, and then there's an extra 150,000 on top of that because of tax complications. But they're allowing for inflation linking of wages in the with it. So what we're expecting is in 10 years from today, the actual fund threshold will be €3.5 million, which goes beyond what we would normally say to people, that in your pension you're actually saving beyond your life goals. It's actually a family method of accumulating assets onto the next generation. And what's important then is that when you're getting to that stage of retirement, there are large nuances between the different types of pensions, both before and after retirement. I've listed there a lot of them, right? You've ARS, PRSAs, annuities, whatever, right? And if I was just to highlight the PRSA, on my list, I have 3 PRSA written down. One is a PRSA, one is an AVC PRSA, and one is a vested PRSA. Now, they all have very different roles, and they all actually, the Finance Act in 2016 brought in pension freezing for both personal pensions and PRSAs. That freezing does not apply on other pension products such as master trusts or executive pension plans. And then so there's an awful lot to this, which means that if you do take advice, that you'll be in a position for what your objectives will be achieved. So, or my advice to you is to do and get advice before you sign your pension claim paperwork. A fascinating year for markets. I actually, when Owen and I were coming up with a name for a webinar, and that's the one that we selected in the end, because every year is a fascinating year for the markets. And really, for those who are investing, it's about time in the market and not timing the market. You may or may not have heard that, but on September 11th, Christine Lagarde said that risks were more balanced. That's quite reassuring. But ultimately, there's always fear. There was a fear. So markets at the moment, as they are most of the time, at an all-time high, but because of the dollar-euro movements, we're not seeing much of that here as European situ investors. This slide explains how, as you were aware, on the 2nd of April, that the man in America came out with his tariff list, and the markets responded poorly. But what we have is, from the start of the year to the end of the year, actually the world MCI in euro terms is actually up positive, but bonds, which is the green line there, is more or less has been level. As you'd expect, like equities are more volatile with a greater return over the longer term, and bonds, which is the other key asset class, is less volatile. So there was a large rotation. So you're probably aware too that phrases such as the Mag 7 or technology has been quite in vogue for many years. And the blue line shows that before, so there was a rotation away from the sectors that were doing quite well before the 9/11 turn in the markets, but they're all back again. So I'm going to repeat again, it's about time in the markets, and you and I don't know and won't be able to call what's the quote unquote best either a sector to be in or asset or geographical area to be in. So what is creating a lot of news is the fall in the US dollar. So far this year, it's moved more or less 17%. We're at 117 now. So that is a very significant shift. So if you're buying, for example, Apple as a share, or much of the technology stocks, they're all US based. So that stock market might be up a lot, but if the currency is falling versus the currency you're in, you could be actually possibly even down. So this chart here shows, we look at the light gray line shows the American stock market in dollar terms, shows that it's up almost 20% by the end of the year, having fallen in April. And then the golden line shows the dollar euro exchange, which means that it's the euro has been strengthening its dollar. But so as a euro based investor, it's this dark purple line that shows that you're more or less where you started at the start of the year, notwithstanding that the US market went up, but it's because of the fall in the dollar. And should you be asking, maybe we just should be hedge against that. But the thing is, in reality, this wall of fear about the dollar is losing its value. In fact, the dollar is where at its median value since the euro inception in 1999. So what we've learned from the past is that things that change, the more things change, the more things stay the same. Gold is another, in a time of worry, people move into the gold asset class. It's certainly coming up in a lot of conversations with me. People asking me, should I move into gold? But remember, we're forward looking, we're not looking backwards. So we need to remember that while gold has done very well, there are geopolitical reasons for it now that we've got from this starting point. Would you put a substantial part of your portfolio in gold? I'd be recommending not, because back to the old wives' tale of don't keep all your eggs in one basket. There are 5 asset classes being cash, bonds, alternatives, equity, and property, and gold is one of the alternatives. Albeit it's in the news. As part of a portfolio, yes, but not as a punt in its own right. What we know from the past as well is that, and this graph here shows the intra-year falls. So we know and we are expecting a bumpy ride at all times. So it would be nice if we were to put our money on deposit and get high single-digit returns over any volatility. But where we as investors are paid a premium by the markets for taking volatility. And we know that before we start, and this is the way it has been and always will be. And in fact, many of you would have got from my colleague Owen and I the big picture chart behind us, which shows that over the very long term, now this is using US data, that an equity only portfolio in the States which was started 100 years ago before the Wall Street crash, will give you approximately a 10% return on average. Now there's a lot of volatility in that, so it'd be up a lot one year and down the next year. But and then a balanced portfolio, which is probably what we recommend to you, has a mix of all the 5 asset classes, and that it may give you, we'll say, an 8% return over the longer term, minus charges. You're down there to 7% return. And interestingly, if you put a lump sum into the markets and you got a linear 7% return, which you after charges, which you won't get, your assets would double in 10 years. But the point on this chart here is that the red dots are showing the worst position during the calendar year. So if you start at 0, that every single year, without exception, you lost money throughout the year. This is expected. And that's why you as an investor, you get paid the premium to invest in volatile assets. What we know from this pie chart as well is that 3 and 4 years, at the end of the calendar year, you're ahead, and 1 and 4 years, you're behind. And in the years that you're behind, it will recover the years afterwards. So volatility is actually our friend, because without volatility, we wouldn't get the higher returns. And if we were in the lower risk asset classes, which are cash and bonds, then we'd struggle to keep up with inflation. And there is a big opportunity cost in actually not being invested in a diversified portfolio, including equities, property, and alternatives, which gold is one of. And then I think this is a great chart because it goes way back to way back, right, to 1950s, and it shows the crisis and how they affect the markets and how negative it all is. But these are, as Warren Buffett would say, these are noise. And if you're a long-term investor, like for example, a threat, a not unreasonable threat in the next 10 years will be obviously a function of how the war for Russia goes against Ukraine. Is, let's say Russia had won that war easily, it'd be reasonable to to think that perhaps the Chinese might have a look at taking back Taiwan. Because for politicians, using nationalism or tribalism was a great way of shoring up support amongst the people. Now, if Taiwan were invaded, then it'd be reasonable to expect a big red here, that'll be a crash. But because we're long-term investors, and no different to the COVID or the 22 crash, the markets returned there afterwards. Okay, so I'll finish at that, and I'll let Brendan. Oh, back to you, Owen. Thanks.
Great. Okay. Okay. Thank you, Seán. Listen, great slides, good messages. I like the one about the complexity of all the PRSA products. It'll probably be news to almost everyone. There's even 3 different products with the name PRSA in them with different rules. So I often think to myself, AI, people wonder, is it going to steal your job? I think I'll be long retired before AI figures out the maze that is the Irish pension system. So now moving on to our second speaker. We're delighted to have Brendan Twohig, tax partner with MK Brazil Chartered Accountants. Brendan is a regular presenter for us. We're really delighted he keeps coming back to us, because every time his name is on the invite, we're assured of a large crowd. So Brendan, look, thanks for the time today. So over to you now. The stage is yours. Thank you.
Thank you very much, Owen. So I'm just going to share my slides there. If you want to allow sharing, lads. I'll share my slides and start talking.
Yeah.
And then I have loads of questions about Seán about his inside track on China annexing Taiwan. That's what happens when Kerry went in Ireland, I say. It starts with taking over Dublin, for you know it. They're in on everything. Can you see that okay, lads?
Yes, perfect. Yeah.
So, right. I'm going to go through this fairly quickly, because it's most of the stuff has been hammered out in the media, and if you haven't caught it or you haven't come across it already, it's because you don't care. Okay, so there's no point in me repeating what you already know, and it's all in your slides. It's long slides there, and there's a lot of information in it. What I try to do is stop at the parts that mightn't come out in the public discussions, or just to give a different perspective on it. And then try and focus on the 1 or 2 positive things that are there, right? And that's hard. That's hard in this budget, right? But that's not a surprise, because we're post-election. So this is what they do. They take it back off you year 1, year 2, year 3, give back to you year 4, and you think they're great, right? And this is every government everywhere, every time. So that's not a complaint. It's just an observation, right? It's important to, just as in terms of the context, a lot of stuff talks about what's going on in the background, what we were expecting. I'm just going to flag a few of these things for you. Climate isn't going to go away, right? The carbon tax is already there. All we're arguing about is how much it goes up every year, but it's going to go up. We're going to hit €100 per tonne in 2030. That's happening independent of the budget. I said that just accelerates or decelerates, but it's still heading that way. Inflation is obviously a big primer, not least because it's linked to our programme for government, which we'll come back to in a second. You've also the global uncertainty, but as Seán had a great slide there, there's always global uncertainty, right? There's always a war or a coup or a crisis or something, right? So, but then it gets mentioned every time. Then you look at the Irish scenario, the housing crisis, the cost of living crisis, the tourism sector. There's always something that needs, there's always some part of your garden that needs water. The programme for government is my favourite thing, because like, this was written this year. So I always have the same question is, you wrote this year, so if you're not going to do these things, was it because you're liars or because you're incompetent? There's no third answer, right? Now, we all know the third answer. The third answer is exactly what I said to you. They'll do this in the 4th year or the 5th year, depending when the election is. But they can't say that, which is why I like provoking them with outrageous questions, right? But it is worth mentioning that in specifically, they are going to index link tax credits, their own index link tax bands, they're going to index link the rent credit. I didn't say these things, they did. The only thing was if there was a crisis and they couldn't afford it, right? Now, then you look at the speculation that's going on, and last week we started hearing about no personal tax changes and this 9% hospitality and this apartment stuff. So, like, I'll let you in a little secret, all the leaks that are out there, they're not really leaks, they're flying kites, right? So when those were still being repeated on Monday, we knew where we were. Just remember then, last year there was a lot of changes, a lot of what I would call anti-family business changes in terms of capping retirement relief, fecking around with agricultural relief for making the transfer or the retiree or whatever you would call it, the parent in most cases, being an active farmer. That was parked up, thank God. It's still in the legislation, but it's not how it's coming in. We had the once-off mortgage interest tax credit, right? Once off in an Irish language. Review share-based remuneration and the CAT thresholds finally moving, all right? They're supposed to be going more again. And we were very interested in what would happen in this year's budget in view of those things and the pushback they got. And lastly, before we look at the budget, don't forget, the PRSI increases is wired into legislation. That's going to go up every October, 1st of every October for the next 4 years. So everyone is poorer in the weeks before the budget anyway. The pension changes are already there. The auto enrollment, Seán mentioned earlier on, that's going to be a cost to everyone because you put in and you have to come out. And if you come out, they put you back in every couple of years and all that. And that's already going to happen. LPT is up this year, which means everyone's going to have to do another return this year. They're going to have to probably get evaluation and they're certainly going to end up paying more in most cases, etc. Right? That's all before we get to the budget. Then we get to the budget. I knew we were in trouble as soon as I listened to the key buzzwords. If you stay hearing challenging times, unprecedented times, historic times, you start thinking, oh no. If you hear we're at a crossroads, you go, oh Jesus. And it didn't disappoint, right? So no change. The reason I'm flagging these is because the heretofore mentioned program for government. This year, not 5 years ago, this year, we will index link these things and we can afford it. Now, we can afford it. They've made great pains to tell us this. Yet we didn't change tax bands. I didn't promise to do it. They did. 2% inflation means it should go up to 1,000 quid. Just a reminder, my bear in this always, because I was on the committee back in the time, in 2010, when we temporarily mangled our tax credits and cut-off point. This is 2016 or 2025. So that's 15 years later. In Ireland, that's temporary. Just like once off is 4 years, right? We haven't moved our tax credits. And again, if we were even back to 2010 levels, we'd be at 2.5 grand now. Didn't index link it, even though they promised they would. And they didn't index link the tax credit, even though they promised they would, or the rent credit, right? The mortgage interest credit, once off, is there for another 2 years. Very, very, very little bit came in for 24, less so 25 and 26, touch wood, because interest rates aren't as big. And remember, it's always in comparison to your 22 interest. USC changes only because of the changes to the minimum wage. The important thing to remember USC is, again, it was a temporary measure. It was a temporary measure. That was a tax on income, but not an income tax, right? I do want to just pause for a second on three things that aren't getting as much coverage, but I think are hugely important for businesses in particular. One is a plan to overhaul the way Ireland approaches interest, both as a deductible expense and as a potential source of income. And they're looking at everything from dirt up to the accruals basis, passive trades, passive rent trades, so forth, versus active case one and so forth. That's going to be very interesting. I'd have a bit of a worry about that because I don't see the change coming out good, is the short answer to that. There's also changing to investments. Now, again, I read a lot of the pre-budget submissions. I know there was a lot of lobbying about this and about the need to overhaul how we tax funds, maybe harmonising the exit tax of 41% with CGT at 33% and doing something with the automatic encashments, okay? Now, before we came on, we were having a bit of a debate on if you might chip in there for 2 seconds. As a very narrow person, very narrow view from a tax point of view, I don't like funds because if you have a loss in a fund, I can't use that loss in sort of gains. But as a man of the world with far more experience and intellect and communication skills, no one likes funds.
Yeah, I have looked just a few. It's not all bad news with funds. I mean, look, the big bit of bad news was the 41% exit tax, and that has decreased. It's been flagged, but I like that. I didn't think it was going to happen until it actually happened. So not alone has that gone down from 41% to 38%, but it is in line with that commitment to come down to 33%, right? So a few positives for funds, right? There's a lot of things you don't have to worry about. You don't have to include them on a tax return, right? You don't have to worry about things like US federal estate tax or UK inheritance tax, where they tax estates as opposed to here, whereas the beneficiary pays the tax. So you've a lot of things that you don't need to worry about. So look, then on the other side, if somebody wants to hold securities directly, their thinking around that would be CGT treatment, and that definitely for certain people comes with benefits. For instance, there could be a bit of tax planning going on there. We know there's a more beneficial treatment on debt. We know there's a more beneficial treatment if somebody has losses forward. So look, it's back to every case is different, back to the point of the need for advice, and just back to the funds bit, right? Another bit I like about funds is often someone comes in, right? Now, I often would say to them, I'm the worst salesman in Ireland, right? They'd come in with a large lump sum and look to invest it in one go. And I'd say, look, why don't we look for a good portion of this to maybe converting it into a savings type plan with a direct debit going in there for a couple of grand a month. And the reason you're doing that is you're drip feeding money into markets. You have money going in when markets are overvalued, when they're undervalued. So look, it's not a one size fits all, but there's good and bad for both treatments, whether it be Irish, based funds, the likes of the life assurance company funds, or whether somebody wants to go down the road of direct holding for CGT treatment. So look, definitely lots of things. Again, I could talk more about that, but I won't. Things like dividends, if you own the shares directly, are at 52%. So look, there's a lot in the mix there, but I'm just going to wrap up and say it's good news to see the 41% exit tax down to 38, and hopefully we'll see more decreases.
Thanks, Owen. Well, we'll agree on this much. It's always good to have options.
And it's always good to see a tax decrease.
Anyway, the other thing that's very worrying to me was the mention of overhauling the Irish withholding tax regime, modernising, digitalising, and expanding. Right? That should worry you, because I said probably I think on the stage with you lads back in the Clarion back in the day, it was definitely in Cork, and obviously it wouldn't be in Cork if it wasn't with G. I made a point that we're going to get to a stage where no one ever gets paid gross ever again. Right? We've POE, we've RCT, we've PSWT, the whole lot. And the way the state wants to work is give us your money, and if you're good, we'll give you some of it back. All right. So when I hear expanding withholding tax, I worry. And at the very least, it's another level of administration for businesses, and not just businesses, but anyone who has to pay anyone anything. Okay. Anyway. So farmers, what I found interesting about the coverage, I heard a few people saying, well, we got nothing. The hard-working people of Ireland, the people who get up early in the morning in Ireland, people who eat dinner in the middle of the day, right? They got nothing. The farmers and the builders got everything. And that just because you mention farmers a lot doesn't mean they got anything, right? Farmers lost money in the budget. That's it. They got the stuff they already have, and they lost the flat rate addition, which matters a lot in terms of cash flow and things for farmers. So they were mentioned a lot, but they didn't do any better than anyone else. Okay. Housing, lads. Look, this isn't the forum for it. I've never fully understood how these things work. If you want to give $5,000 to someone to buy a pram, you're a socialist and a left winger. When you give $5,000 to someone building an apartment, you're a modernist right winger. To me, the state is either paying for something or it's not paying for something. I never understood this left wing, right wing thing. I know this much. I know that an apartment that was for sale yesterday for 200,000 hasn't come down to 180,000 today. So I'm not getting that fat being passed on to me. So I just find the whole thing strange. There's also a little nuance in there because there's any accountants on that people might have picked up on the enhanced tax credit. In other words, if you spend money in building apartments 10 or more, you get a wider deduction for certain costs. That's only if you're the owner. In other words, if I'm building 10 apartments tomorrow, I pay less corporation tax. But if I own the site and I hire own to build apartments tomorrow, I mightn't get it. So it seems to be very specifically targeted at owner developers only, not everyone. They're not encouraging anyone else to go and start building apartments. We'll see how that goes on the final. Whether that's deliberate or not, I have to imagine it's deliberate because they wrote the fucking thing, but we'll see if it's still there when they get to the finance bill or not. It's a very weird quirk in this. My issue about all this is all the commentary is about housing and homes. There's nothing about houses in here. Apartments, right? Apartments. And also, by the way, in case you missed this, God forbid Pascal would have given us a budget and not give us another new tax. We now have another new tax, the derelict property tax. You're thinking that doesn't bother me. We already had a derelict site levy. You did and you didn't, right? The derelict site levy wasn't usually enforced, and it was really for empty places around the city. This isn't what that's going to be, right? And you'll be amazed how many people have derelict properties that they don't regard as being, like, as recently as yesterday morning, we were trying to make sense of a guy who bought a bit of land, and I couldn't reconcile the VAT or the stamp duty back to it. And when we went back, we found out that because there was an old rules for cottage, a portion of the process had been allocated to residential for stamp duty purposes. And I was like, good news for you now, when we were derelict site. No, he didn't have to worry because he's in the country. We'll have to worry in 2027 because he's going to be paying derelict property tax. It's another set of returns, and it's one of those ones where you're going to be brought in and you have to beg to get back out again. So just in case you had found a month in the year that you didn't have a tax return, Pascal's got you sorted. Don't worry about it, right? Landlords, look, the Living City Initiative might actually become something at some stage. It's already in Cork and all that. We looked at it back in the day and moved away because it was Georgian properties. We're probably going to have to look at it again now that it's pre-1975. It's kind of like urban renewal in that you get capital allowances on the capital spend on a property. So well worth having a look at. I'm not saying I'd go out and buy something I wasn't going to buy because of this, but I might be able to do something with something I was going to buy because of this. Also, there's a weird thing in there about the cost rental scheme, which is if you don't know what they are, they're for people who are too rich to get social housing and too poor to buy a house, right? So as we call it, everyone under the age of 40, okay? And they go for this cost rental scheme, which is basically usually run by housing boards and land development agencies and so forth, where they will take the houses, figure out what it's going to cost them to build them, run them, maintain them, and all that, and finance them, and then rent it back to someone to recover their costs. So they're not supposed to generate a profit, and they're supposed to come in at 25% or less than market rent. I didn't know you could rent directly from companies. I thought it was always through the LDA or something like that, but apparently you can, or at least you will be able to. But there was a very good question about this: is if these are designed not to make a profit, why do you need to exempt the income? And if you're still making a profit, even though you're 25% below market value, Jesus, everyone else must really be making out like a bandit, right? Because the other 25% must be pure profit, which begs the question why you all need so much help to begin with. So anyway, there are longer conversations. Also, just to shout out the foreign earnings deduction, or usually underappreciated by people. If you're rich and you're doing your own business, just pick better places to go on holidays and pretend you're marketing. But certainly, when it came in first, it was very narrow. Now it's like a lot of Africa, a lot of Asia, a lot of South America. And if you're doing it anyway for marketing and expansion purposes, you might as well get the tax relief, okay? So the R&D credit, again, this isn't the forum for it. There's been you remember me talk about this before. A new tax relief comes in, no one knows what to do. We start pushing the envelope, we get to what we call the unbelievable moment, and now lads are taking the piss, right? And when we get manufacturing relief for bananas, that's when the government say, hang on a second, no lads, you're at the unbelievable moment. And they push back. And when they push back, you can't get manufacturing relief for manufacturing. And we go, geez, lads, what's the point? And you end up in the middle ground. We're getting there now with R&D. It's going to be a very good relief. It's going to be very good credit. Don't think you're going to get this if you're Irish. It's for PLCs. That's what I said 5 years ago. No. Do I want to discourage Irish guys from claiming it? No. If you survive the culling of the last 4 or 5 years and you still think you have it, by all means do, right? But that's what they've really been doing for the last couple of years, get rid of all the little Mickey Mouse ones, okay? So, now, entrepreneur relief change, there's two ways you can look at this. I got a lot of negativity about this because we're supposed to be going to 5 million. Again, I didn't promise this, they did. We were supposed to start the 10 million cup in the UK. We ended up starting a lot lower at 500,000, promising to grow steadily to 5. And it took about 5 years to get from 500 to 1 million. It's taken about 5 years to get from 1 million to 1.5 million. And it's kind of a little bit frustrating. But I can tell you, there's been a genuine concern about this relief for the last couple of years that they're just going to get rid of it because they're doing nothing to help us, nothing. There's been a load of valid questions in terms of moments or areas of confusion in the legislation. We're not going to really understand this till we review tax cases. No tax advisor is going to say you're going to get on entrepreneurially because we don't know, because the legislation is so vague. The revenue hate it. So a lot of the concessions and things that we'd won over on similar, almost identical issues for retirement relief, they will not pass on to entrepreneurial relief. You can't go entrepreneurial if you have an empty company in the group, for example. So this is the first time now in a while that someone has done something that makes me think, actually, we might have this. This might actually be worth something for the next couple of years. It's very valuable for entrepreneurs and business people. Not just as like, it's not just you sell your business and make money. It can also be a handy way of giving businesses to your children where retirement leave doesn't work for whatever reason. We're going to know if this is serious or not if we get updated guidance in the next couple of years or next couple of months, because there's a huge lacuna around this. If we don't, I'm going to go back to worrying about it. But I didn't know they would do this. I'm delighted they did. At least it's not quite an engagement ring, but we're still going out to the pictures on Saturday night, and I'll take that for now, okay? The rest of the stuff really annoys me. I'm not going through it again. We're still at 33%. We're still knowing indexation, stroke tapering, stroke inflation allowance. In other words, we're still the only country in the world that pays taxes on losses as if they're gains. And we still haven't changed our annual exemption, which is just farcical. If you're not sure how long ago it is, look at the number. 2022 is when the euro came in. So it's over that, or 2002. So it's over 20 years ago that we haven't changed that, okay? And very disappointing there's no changes to CAT. A big jump last year at long last, but nowhere near the 500,000 we're supposed to be getting to, and also nothing on the Class B threshold. To be blunt, 40,000 is too small, a lifetime threshold for siblings, uncles and aunts. Now, 40,000, your brother isn't going to turn around tomorrow and hand you 40 grand, right? But over the course of your life, like, there's kids these days, they're getting that for their fucking confirmation, right? So it's too small a number for family members. I'm not saying this is accepted that this is the case. I would hope there'd been some movement in that. There isn't, right? The VAT stuff we talked about already. The interesting thing about the hospitality sector is that it's not starting till the summer, which is bad news for a lot of the small cafes that apparently they're all worried about because they won't survive January, February, March. That's when most of them close. They do their best. Basically, you hope Christmas keeps you going to Patrick's Day. You hope Patrick's Day keeps you going to the summer, and then you're making money in the summer. So that's disappointing. The reason you're hearing some controversy about this, by the way, is no one's talking about the small rural hairdresser or the little cafe in the whole lot. The reason this is so controversial is because everyone gets it. 90% applies to everyone. So that's why you hear people getting about McDonald's or Supermax or Burger King or whatever. This could have been targeted in terms of your turnover at a certain level or something like that. It didn't have to apply en masse. So for the smaller businesses that it's supposed to help, any difference this would have made was wiped out with the minimum wage increase. Minimum wage means if you have 3 staff, you're paying an extra 9 grand next year. That more than cover the VAT side of it. Whereas if you're one of the big global crowds selling hundreds of thousands every year, this could go over 40 grand a year to you, right? Now, they're also impacted by the minimum wage and all this malarkey. I'm not saying it's right or wrong. I'm just saying in case you didn't understand what the debate was, it wasn't about Mick and Mary's Cafe versus Mick and Mary's customers. It was the Supermax, the global crowds who benefit the same way as Mick and Mary's Cafe, right? The one thing, just a flag fee as well, about what was mentioned that doesn't get a lot of coverage is the move to VAT modernization. What that really means is, do you know how now when you pay your wages, you're not paying them on your own systems anymore, you're paying them on the revenue system or Big Brother system as it's known. That's about to happen for VAT, right? So gone are the days where you can fix your VAT, oh geez, I have to issue 2 credit notes and put out a different VAT. That's all going to be done through the revenue system, right? Now, this isn't going to happen in my lifetime, but we will be sitting here one day and you're going to talk to someone who's going to explain to you how we know of only one big bank account in the world that we're all allowed access to pay people on. And if that sounds far-fetched, if I had told you 20 years ago you'd be paying your staff through the revenue system, you'd have told me a nut job. If I told you we're going to do your VAT accounts through the revenue system, you'd call me a nut job. The rest of the stuff then wasn't usually interesting, so I'm going to move on it. So I started typing up the stuff that didn't happen, that we thought might happen, and I said, you know what, I couldn't be bothered, right? I don't buy this whole, oh, wait until the 4 years and enjoy just by that. That's not, I am here, it is now. Beyond that, all human knowledge is, I can't remember, bunkum, right? So there were a few things that kind of annoyed me or stood out, good, bad, or indifferent. I don't like the complete abandonment of small Irish family businesses. The changes that they get are more paperwork, more admin, more cost, and limitations on their ability to do succession. I don't like that. I like that as an advisor, because the harder it is, the more complicated it is, the more you need me. Okay, so I'm not gonna bite the hand that feeds, but if we're not going to start doing something now, and again, not my words, there's a whole action plan being set up to make things easier for family businesses and to ease the administration burden. I'm not seeing it yet. And obviously, as I said, the CGT, CAT things, they have to change at some stage because they're too low, and we shouldn't be paying tax on gains that we don't make. The inflation one annoys me because they only wrote it this year, right? And I had a politician giving out to me this morning about this. I was doing a debate, and I said, lads, I'm going to say to you the same thing I said to my wife. Don't give out to me for listening to you, right? You said you're going to do this. You didn't do this. I'm simply pointing it out. Not my fault. I'm the good guy here, right? I didn't lie. So those things annoy me because we just take them for granted. We shouldn't take them for granted. They didn't have to say they were going to do these things. We would have understood if they said. They just said, look, over the course of the time, or we'll do our best. But don't say you're going to do something 2 months later. But then what surprised them? The war in the Ukraine, did that start in the summer? What happened? Donald Trump went off the rails. Did that surprise anyone? So what happened between writing this and doing this that changed our minds? I don't know. There's a serious lack of clarity around things that we need. I'm hoping they'll come into the finance bill, but normally, as I say, what you have to remember yesterday is, believe or believe not, yesterday is the good news day, right? So I don't expect good news to come out of the finance bills or the Finance Act. What's going to go next? Well, entrepreneur relief. Look, it's not 5 million, but it's still there, and it's very valuable. We'll take it. As a taxpayer, stroke business, stroke advisor, stroke anyone who has clients or employees, whatever, I'd be worried about VAT modernisation. I'm very worried about the review of the interest regime, and I'm very worried about the expansion of our withholding tax. When it comes to housing, I ask this question every year. I don't know what we're doing. We can't keep giving money to landlords and tenants and pretend we're trying to solve something. Anyone who's ever been on a seesaw knows that's not how it works, right? I don't know why we're just differentiating between developers and owner developers. Not sure what that is. But here's what I do know. I do know that they're talking about apartments, not houses, right? As a matter of fact, I'm now being dissuaded from building houses because they're going to get more tax breaks and better share the profits on apartments. So the question then becomes is, do we think the solution to this is more apartments? And I'd go back and read the speech where he's talking about overhanging planning, because we're going to put houses where they're needed. In other words, forget all this green space and long-term plans. We're going to stick houses where they're needed and for what they can afford in those areas. Now, I'm of a generation, I know what that means. That means Ballymutton. That means Finglas. Drive up around the north side someday. And God knows that solved all our problems. So who am I to argue with it, right? And I don't like the fact we have another tax. I certainly don't like it's another derelict property tax. Or someone had a great thing to go about encouraging the reactivation of properties. That's not what it is. That's one way of putting it, right? And then one, which I appreciate the lads might come back in and if they don't mind, one of the things that's coming up now is, as a layman, I know enough about pensions and investments to be dangerous, right? My understanding of the things, what the sequence of events was simple. Master trust schemes, we had a bit of an exemption from some of the administration burden. That came to an end, and then they upped the manual or the admin side again. So a lot of people flooded out of the sense, not customers or clients, but actual people who run these things, trustees and so forth. So there was a big problem in the pension sector that we couldn't get people to run the funds. We said we better dust off the PRSA. It's been sitting there for 20 years doing nothing. So we dusted that off and put it onto the pitch. When we put it onto the pitch, we realised we just let a mad dog loose. There was a reason no one had touched it for 20 years. And, and we had to roll back in a small bit by putting a cap on the funding. But the cap on the funding is too severe for wealthy business people. So now PRSA, again, not still valuable, but it's not the main thing anymore. Sean, you had about 20 different screen pictures or pension funds up where to go. Where are we now? Is it genuinely they're all available, or is there one, like, is the master trust scheme still a problem, or have you no problem getting people to run it for you now?
So Brendan, the answer to it is the great accounting answer. It depends. So yes, up to December of last year, for new customers and even some existing customers, the preferred funding method for company directors was the employer paid PRSA. It has advantages, and but PRSA and master trust, they have advantages over each other, and some of them are nuanced. But as we stand today, when someone comes to me, in general, let's say it depends on their objectives. So most people's objectives are to be able to fund more money into their pension and get corporation tax relief for that funding. So again, it does depend, but I could say that in general, if you're in your 40s, have quite a number of years service with your company, you can fund more by the master trust than the PRSA, because the PRSA is, so imaginary scenario, you're on €30,000 a year, and with a employer paid PRSA, the employer can match this the salary in as a pension payment. So that'd be 30,000 salary. So therefore, the pension payment can be from the employer. Now the employee can do a separate one. Can do their own €30,000. That's in the PRSA structure. Again, I'm afraid I'm going to be losing people at this stage. But the alternative is the master trust pension structure. What a master trust pension structure can do is it can say, oh, you've been working with this company for 10 years. During those 10 years, the company wasn't paying any money or much money into your pension. So we'll back fund. And lo and behold, on this $30 salary, the company can put in, again, we'll just say 100 grand in the year, or 60 grand, we'll say. So if the company puts in 60,000, then 30,000 can be an ordinary annual contribution, and the second 30,000 of the 60,000 will be a special contribution, and both will be allowed for corporation tax purposes in the year. Similar to when you're taking your retirement benefits, and what Brendan, you said earlier about this is complicated and it keeps people like Owen Buckley and myself in jobs. But we have the tools at our disposal to check in your particular circumstances which of the two of the funding structures work. Now, and it isn't also about how much funding. There's also an element of that the death benefits are better in a PRSA scenario than they are in master trust. But go and get advice would be
My point, Sean, is the feeling was there was a problem with the market for it, but you don't have that. You don't see that now. If I go into you tomorrow, they're all available to me. I can pick the one that you think works for me best.
Yes, and yes, that is correct. So I suppose talk about the feeling that there was a problem in the market. What happened was, up to several years ago, up to relatively recent, and even so continuing, everybody had their own occupational pension scheme, and they themselves were their own they were their own trustee, and we had a ridiculous amount of trustees in the country. So what the government have been trying to do is professionalize the trustee role, and that's why the language of master trust has been used. So the answer is yes. Somebody comes in today. we can offer a person either a PRSA or a master trust, which is an occupational pension scheme, and it will depend on the person's circumstances, and they're both very much available. The old defined contribution occupational pension scheme with your own trust, where you were the trustee of your own company, that's gone, but the mass trust is there.
And just one sentence from me on that. Would you believe that you can actually have both? It's not an either or situation. So you could have somebody coming in and we could say, right, Brendan, look, it makes sense to put the first 50,000 into a PRSA here, and now we're going to do a second contribution, and it's going to be towards a master trust-based scheme, which, as Seán mentioned, you're into a bit of complexity there, ordinary annual contributions, special contributions. So you can have both at the same time.
Well, look, again, we're back to the same thing. We have options, right? So that was. It's just important to understand you're in the sector. Sometimes you can't see the wood for the trees. I'm only ancillary. I'm only parked next to the trees, and that was certainly the perception. Well, that was the explanation that was given when they changed the PRSA rules. That was the explanation they were given. They had to do it. But look, options are always good. I say this to people. People who come into me, I'll be meeting someone tomorrow and they're in their 60s and they have kids and they have money. We have what we call the funnel problem. They have an estate worth this much, they have thresholds worth this much, and how do we get it through? And then they'll be going home with a headache because they have 50 different options. And goes, they're the good meetings. You know what the bad meetings are? The bad meetings are where you have no options, you just have fucking consequences. So the bottom line with the pensions is they're all back on the table. Right? And then you can cherry pick. And Seán says, look, there's a load of them out there, and sometimes it's not an either or, you can have both. And sometimes I would imagine you can have both and then change your mind later on anyway, right?
That's it, yeah.
Horses for courses. Right. So look,
and Brendan, not to forget with the pensions, the key thing there is you could have decades of tax-free growth. Like the money can go from the balance sheet of your company into a personal asset for you, decades of compounded tax-free growth, and then you get lump sums in retirement, and you have a choice then in retirement, either taking an annuity for the rest of your life, or it goes into post-retirement product, which is either a vested PRSA or an ARF, and it again grows within the structure tax-free. And to be fair to society, it's only right there is some tax paid at some point. So as the withdrawals are taken out of it, there's income tax on the withdrawals, but it can be arranged that if your income is let's say as a couple is less than 88 grand, if you both had ARFs or post-retirement products, that you could be taking the money out at 20% tax, while when you were earning the money, it was if you had earned it as a PAYE worker at that point early on in your career, you'd be paying marginal rates, including PRSI and whatnot, of over 50%.
I don't think any tax plan, Seán, for wealthy people can ignore pensions. It's as simple as that. And we've done this before. We did a presentation a while back, I might remember, where I have 100 grand in the company, I take it out, pay 52, I have 48, I get hit by a bus, my kids pay CAT, and the state is getting 2/3 of the 100, my family are getting a third. Whereas I took that and stuck it into a pension to come into an ARF and go to my children got a third or 2/3 and the state got a third. Do you know what I mean? So I don't think any tax plan, like to me, just pensions have two functions. The first thing is you have to make sure that you're comfortable in your old age. You've worked too long and hard to make sure you're financially secure. Now that's done. Now the pension moves away from funding your retirement and moves into our camp, which is it's another club in the bag, right? When I'm looking at transferring wealth from one generation to another, any succession plan has to involve pensions, and it's good that they're all back on the table. Now we'll see what happens, of course, in the finance bill. But anyway, look, we'll move on. But it was interesting that the perception that people had that this was gone, but it's not gone. Obviously, it's still very much available and very much still an option for people. So, look, in summary about the budget, what did we expect? Right, it's the year after the election. We had very low expectations, but even then, I will be honest, I expected the tax bands and credits to go up. It would have been €1,000. It would have been a fraction of the cost. You could have delayed the start of the 9% VAT on apartments, because let's face it, every apartment for sale yesterday is still for sale today for the same price. They're all 200k plus. So all that's happened is some guy has gotten 50 grand. It hasn't changed the price, right? So I don't fully get my head around that. It was an easy promise to keep, and it's antagonized a lot of people for no reason. I'm still disappointed we don't do like even something as simple as the CGT indexation. That's always been something that annoys me. The lads, Sean gave a lovely little chart for the go. His whole, sorry, Sean, it wasn't all you said. You said a load of things, but one of the core things you got across was volatility is part of the game, right? Now, to me, if I'm brave enough to invest in something, and I'm brave enough to take my chances, and it goes up, I'll pay my tax. But when it doesn't go up because of inflation, when I've actually lost money, why am I paying tax? I don't understand why we're still taxing people on gains they don't make. It's an easy fix, and I don't understand why that. It's not even on the radar anymore, except I keep putting it in there, right? So the other thing again is what I always say about these things. I'm missing a plan as to what our plan is for R&D. Yes, but that's not today's plan. That's just the last one coming in. Unless our plan is more and more apartments in poorly built in poor areas, that worked well in the 80s. So I might say it won't work this time, right? So I always finish with I'm not angry, I'm disappointed, which is the classic sitcom line from a parent. I say sitcom because in real world your parents say, I am angry and give you a clatter. I've added one little part with the previous years, which is I'm worried because of the little thing about the interest, the little thing about the withholding tax, the little thing about the derelict property tax, all more paperwork, all more hassle and very little reward. So full of joys, lads.
No, that's great. Listen, Brendan, thank you very much. Right, for me, you remain the only tax advisor I know that leaves the crowd wanting more. Right, so listen, thanks for taking the time to be
but
with us.
having less one, having less but wanting. But I should be minister for fucking justice or for finance.
Yeah. Well, the proof of that now is there's another webinar at 1 p.m. that you're speaking on for the Chartered Institute of Management Accountants that I'm going to log in and watch a second time. So how about that? So look, questions. There's not too many of them, Sean. For you, you mentioned gold. Could you expand on the use of gold in an overall investment portfolio?
Gold is an alternative investment. It's if we go back to the start there's 5 asset classes: cash, bonds, or at the lower end of risk, and alternatives is in the middle and can be high or low, and then you've equities and property at the higher end of the risk return spectrum. So gold actually has had an almost uninterrupted run since 2022 due to buying pressures from the central banks as a hedge against inflation and foreign currency risks. So they've been, so we had in 2022 the Russia-Ukraine war, and since in 2023 we've had the Middle East geopolitical crisis. So normally gold works the opposite to bonds. So when bonds go down, gold will go up, and but actually interestingly, just in this current ill-ease of geopolitical problems, that they're actually gold and bonds are working in parallel. Now, what I would say as a general rule is, if you're hearing in the pub that you should be buying a bit of gold, then it's definitely a bad idea. So so really it's a small part, and even like the life companies, their professionals who work every day and week in it will be overweight in gold, but yet it's only a small portion of their portfolio. And I do recall meeting a client before who told me down his local bank branch he actually had physical bars of gold. That's not really like, as part, it's like going for, I don't know, every day we have 3 meals a day, we might eat one potato, and we spend our time talking about the potato we ate while we've eaten loads of other things. It's just a small part of the overall scheme, and interesting to talk about. but not.
Just a second question for you, Seán.
Yeah, okay.
Tariffs, any comment on tariffs and if what effect they have had, if any, on overall consumer confidence?
My feel, yeah. So tariffs, they've, like, I suppose consumer confidence is more of a wait and see situation. I mean, go back to what Christine Lagarde said about balanced risks, and I think that people are subdued, nervous, but not collapsed. So tariffs are, you know, I think they're. I mean, my sense is that the people who are actually getting the or paying the tariffs don't realize it's they pay the tariff. So if there's a tariff of, let's say, 15% on EU goods going to America, we don't pay those tariffs. It's the American consumer that pays it. And the problem with the tariffs is that they're being sold as a panacea, and they aren't. And the you know, there's an element for me that are we is there an empire coming towards the end of peak power, and with that that's creating a fractious economy and society. You can see that in, let's say, in France or in the US at the moment.
Thank you.
Can I just say that the problem with tariffs is, if you're committed to them, you need to give them 20 years to work.
Ooh.
Because if you want to make it harder to bring in stuff so you can develop your own manufacturing, that takes 20 years. So the question is this: do we believe the US is committed to tariffs for 20 years? Now, I can answer that for you, lads. So sometimes I feel like I went to sleep and I woke up as Michael J. Fox and I'm Back to the Future. You know, Ireland, we're going to go back building high-rise apartments. America's going to go back to tariffs. So I don't know. If it didn't work before, it won't work then. That would be my view, right? But I think you might be onto something with the volatility. Like, tariffs cause volatility, which means some people get rich, some people get poor. But if it's a long-term strategy and that's fine, then over the next 20 years we might see. But I don't think they'll survive the next 20 months.
But Brendan, if it was such a good idea, then how come governments have, I mean, it's been the direction of travel has been away from travel. From
point, Sean, it's Back to the Future. That's my point. Did I wake up in the 70s? I missed it. You know what I mean?
Yeah.
No.
Brendan, a bit of a longer question here. It's to do with the VAT reduction on apartments. Is estimated to cost 250 million in 2026, 390 million on 2027, based on building targets. So I think the person is saying, look, these building targets are probably never going to be met. So are they just kind of offering a VAT cut? Apartments will never be built. The VAT reduction will therefore never really happen. Is this something real?
Oh, don't get me into trouble. Because what I'm telling you is, if I'm a developer with apartments for sale, today I'm getting that VAT break, right? So the question is the implication of the question that this will not actually encourage development of any more apartments? Mm-hmm. If that is true, then you have to wonder, then what does it do? Well, I can tell what it does do. It gives people the money today. It doesn't bring down the price of the apartment. Go in and check it. What was for sale last week is for sale today. But the VAT has gone down. So who's getting that 20 grand? It isn't Mary and Johnny buying the apartment. Anything after that, I'd have to say, off air, I'll be getting sued by 14 different political parties and probably 3 county councils and the developer. But the biggest problem with the apartments at the moment, just so we're clear, is funding. Go try and get funding to build 20 apartments tomorrow and see how it can do. It isn't the lack of demand and it isn't the cost. Try and get the funding to do it. Well, look, we'll see. But I don't, much like I don't think tariffs is the answer, I don't think apartments are the answer. Right? So, yeah. Can we guys, will we start with immigration or make the full suite of 1970s?
And do you see further incentives for apartments to be built? Do you think that's something to watch?
I'm a very simple man. I don't understand why we need incentives to build something if we have so many people wanting to buy it. I don't know. You know what I mean? That is not. If the state is getting involved in doing things people want, then that's socialism. I thought we were moving away from that. As I said, I've never understood how this works. If there's a demand for it, why isn't it being built? Why do we need to do anything? Well, someone will give you 50 different answers for that, but either commit to the market or don't commit to the market. I don't mind.
No, have you? Okay, very good. Look, we've gone 5 minutes over, so thank you to Sean, thank you to Brendan, and thanks to everybody who tuned in. And if there's any other questions, send them on and we'll get them answered. So perfect. No, very good. Listen, thanks to everybody. Have a good day. Bye for now.
Thanks to everyone.